Thanks for joining us at XM.com. I'm Cristina Marujos, and you're watching the Daily Market Comment by Mario Sajkiriakos. Bets that the Fed will take a sledgehammer to crush inflationary pressures continue to escalate. More than 4 rate increases are now priced in for this year, which means traders have started to entertain the idea of either a 5th increase or a double hike of 50 basis points to shock markets and pummel inflation expectations back down. This has translated into a mighty rally in U.S. Treasury yields, which have powered higher to eclipse pre-pandemic levels with a little help from surging energy prices. It really is the breakneck speed of this move that has taken many investors by storm. Once the bond market starts to ring alarm bells, that fills the stock market with fear. Higher yields also make it more difficult to justify price evaluations, hence why the purge usually begins with the riskiest companies. As such, it is the tech sector that has suffered the most damage, with the Nasdaq losing 2.6% yesterday and futures pointing to another bloody nose today. The battle could be decided around the 200-day moving average, a barrier the index has never violated during the pandemic recovery. The FX market has pretty much stuck to the script of risk aversion this week. The dollar is leading the pack as rate differentials continue to widen in its favor, and nervous traders look for shelter in the reserve currency. And while rising yields are usually anathema for the yen, that hasn't played out this time, with its safe haven qualities outshining its rate disadvantage. Instead, the biggest loser has been the euro. Even though European yields have also joined the global rally, American yields are rising much faster. That has clipped euro-dollar's wings. The bad news is that there's more scope for losses. Money markets are currently pricing in 20 basis points of ECB rate increases by year-end, which seems rather unrealistic given the gloomy growth prospects in the euro area, even if inflation has fired up. Elsewhere, oil prices remain elevated near multi-year highs, benefiting from a combination of supply concerns and demand hopes. An explosion in a pipeline running from Iraq to Turkey was the latest episode in a series of production disruptions lately, while on the demand side, there are growing hopes the pandemic might be downgraded to an endemic soon. The spotlight will fall on the Canadian dollar later today, as the nation's latest inflation numbers could either lead traders to fully price in a Bank of Canada rate hike for next week or turn the event into a coin toss. Thank you for watching today's Daily Market Comment here at XM.com.